Imagine ditching your 9-to-5 paycheck and living entirely off monthly dividend income years, maybe even decades before traditional retirement. Sounds pretty amazing, right? Well, in today's Explainer, we're unpacking the exact math and strategies to make that a reality, diving right into what it takes to achieve absolute financial freedom.
So let's jump right in. The massive question on everyone's mind is, can dividends actually replace your paycheck? We're going to look at how everyday investors are using dividend stocks not just as a cute little side hustle, but as their primary vehicle to escape the daily grind and finally take back control of their time.
To get us there, we'll be following a quick roadmap today. We'll cover the FIRE and dividend connection, run through the math of passive income, look at choosing the right investments, navigate common risks and mistakes, and then wrap up with your early retirement strategy.
All right, starting off with Section 1, the FIRE and dividend connection. Let's get our foundational concepts locked in. Now, you've probably heard the acronym FIRE tossed around: financial independence, retire early. Traditional retirement is all about waiting to hit that magic age, usually around 65. But FIRE, it totally flips the script. It's all about building a reliable stream of passive income that completely covers your living expenses. Basically, you reach a point where you work because you want to, not because you have to.
And the absolute engine for this passive income? Dividend stocks. Think of a dividend as a literal slice of a company's profits. When you own shares in a dividend-paying company, they actually hand you a share of their earnings, usually every quarter. It's cold, hard cash deposited right into your brokerage account, just for holding the stock.
Now you might be wondering, why dividends instead of just betting on the next hot tech stock? Well, when you contrast dividend investing with growth investing, it totally clicks. Growth investing relies on the hope that a stock's price goes up so you can sell it for a profit later. But dividend investing, that's all about regular, predictable cash payouts. You literally don't have to kill the golden goose to get the eggs. It gives early retirees the reliable cash flow they desperately need.
Moving right along to Section 2, the math of passive income. To really grasp how this replaces a salary, we've got to look at the numbers.
Before we crunch the data, we have to quickly define dividend yield. This is the exact metric that dictates how much cash your portfolio is actually going to generate. It's simply your annual dividend payout expressed as a percentage of the stock's current price. So if a stock costs $100 and pays out $5 a year in dividends, boom, that's a 5% yield.
Let's take those abstract percentages and anchor them into some tangible annual income. If you look at $1 million portfolio, a really conservative 3% yield gives you $30,000 a year. But if you optimize your portfolio for a 5% yield, that bumps you all the way up to $50,000 a year in completely passive income.
Let's make this highly personal. Say you sit down, run your household budget, and figure out you need $5,000 a month to live comfortably. That's $60,000 a year. To generate that without ever touching your principal, you'd need roughly $1.2 million invested, assuming that 5% average yield. And there it is. That becomes your ultimate target number.
With the math clear, let's dive into Section 3, choosing right dividend investments. Let's look at the actual vehicles you'll use to hit that target.
You honestly have a ton of great tools at your disposal here. You can look at Dividend Aristocrats and Dividend Kings. These are legendary companies with decades of proven, consistently increasing payouts. Or, if you're not into picking individual stocks, Dividend ETFs give you instant diversification. You can also tap into REITs for real estate exposure, or lean on ultra-dependable sectors like utilities, healthcare, and consumer staples.
But to really make this work, diversification is absolutely key. By spreading your money across different vehicles, say parking 40% in broad ETFs and putting 20% chunks into REITs, healthcare, and staples, you dramatically reduce your overall risk. Basically, if one sector takes a hit, the others step up and keep your income rock steady.
And here is a massive pro tip. While you're still working toward your target number, do not spend those dividends. By reinvesting them through a DRIP, a dividend reinvestment plan, you automatically buy more shares, which then pay you even more dividends. Historically, this reinvestment accounts for a massive chunk of total stock market returns. It creates an incredible snowball effect that dramatically accelerates your wealth over 10, 20, or 30 years.
Of course, no strategy is completely bulletproof. So let's head into Section 4, navigating risks and mistakes. Depending entirely on dividends definitely exposes you to a few vulnerabilities you need to know about. Companies can hit rough patches and execute dividend cuts. Inflation can quietly eat away at the purchasing power of your passive income.
Then you've got market crashes, bankruptcies, and the danger of sector concentration if you aren't properly diversified. Oh, and don't forget to plan for taxes on your dividend income, which can definitely take a bite out of your net cash flow.
To protect yourself, you absolutely have to avoid the ultimate beginner trap, chasing high yield. If you see a stock boasting a 10% or 12% yield, that is almost always a huge red flag, signaling an impending dividend cut or deep financial distress. Smart investors know to accept a moderate, sustainable yield. It gives you safe payouts balanced with the potential for long-term growth. Trust me, higher yield is definitely not always better.
All right, let's tie everything together in Section 5, your early retirement strategy. Let's build your actionable roadmap.
What does a winning strategy actually look like on a day-to-day basis? It essentially boils down to 4 disciplined steps. First, you invest consistently every single month, totally ignoring whatever the market is doing. Second, as your income grows, increase those contributions. Third, relentlessly reinvest all your dividends to harness that incredible compounding power. And fourth, build a well-diversified portfolio. By sticking to this plan, pretty much anyone can systematically build their way toward true financial independence.
I want to leave you with this core idea. Retiring early isn't about getting rich overnight or gambling on some secret meme stock. It is a marathon, a long-term wealth-building strategy. Consistency and patience are going to matter far more than trying to time the market perfectly. Every single dividend you earn today is literally one step closer to your ultimate financial freedom.
So now I want to hear from you. Take a look at your own living expenses and your own big dreams. How much monthly dividend income would make you feel truly, completely financially independent? Drop your specific goal in the comments below. And hey, if you found this explainer helpful for mapping out your future, make sure to hit subscribe for more practical investing strategies. Thanks for hanging out with me today, and happy investing.